In today's video, I want to talk about a marketing tactic of sorts that I've seen a few advisors use recently that I would label as a lie, deception, or at the very least, misrepresentation. Now, I have no idea how widely used this tactic is, but it's one that I've seen firsthand and have recently come across at a more frequent clip. Let's discuss this deception and tell you how to spot it and ultimately avoid it. For anyone interviewing a potential financial advisor, most advisors will follow a somewhat common process. Typically, they will meet you once or twice on the front end to find out what you are looking for, gather data on your situation and goals, and ultimately decide if your goals and what the firm has to offer is a good fit. From here, most advisors will deliver some kind of initial analysis talking about where your plan sits today and what that advisor can do to improve your plan. This analysis might be delivered in a meeting or document, but typically is some kind of deliverable. Just as a side note, I would personally be cautious about working with someone who doesn't provide some kind of initial analysis. Some advisors will tell you to move your money first and then they will start providing value. Entrusting your life savings with someone requires a ton of trust and confidence. And if someone is basically demanding trust right off the front end, again, you're free to do whatever you like. But I would personally recommend seeing some kind of analysis to ensure fit and that advisor can add value beyond their fee. But assuming this initial analysis is beneficial and aligns with what you are expecting, then a relationship is pursued. Now, this is the process where I see this deceptive marketing tactic come in. Many advisors today use a probability of success scoring system in the process of building out plans. Based on these given assumptions, you have an X% probability of success. So let's say in that initial analysis, as your situation sits today, the advisor comes back and says you have a 64% probability of success. Ouch, that's not a great score. You basically have a 1 in 3 chance of your plan failing. At first, seeing this, you might be extremely alarmed. Holy crap, how much longer am I going to need to work to improve that score? Well, here comes the advisor to save the day, because in reality, you don't have to change your retirement timeline at all. All you need to do is work with that advisor and implement their proposed strategy, and look at that, you are now at a 92% probability of success, which is obviously a lot more comforting. So effectively, the message here is you are screwed if you stay on the path that you are on. But if you hire me, I can change your plan around and build a very safe retirement plan for you. Now, a couple of things to note here on the front end. Just because there is a material change in your probability of success score does not mean that advisor is being deceptive. As we will discuss in a minute, there are extremely legitimate ways that you might see a big change in that success score. Second, just because some people in this industry are using deceptive tactics does not mean that you should write off all financial advisors altogether. Just because one or a group of dentists, lawyers, or builders use not so great practices does not mean you should throw out that entire industry. But there is a reason this tactic works, and it's not just a financial advisor tactic. Media outlets are a perfect example of this. It's become very clear that negativity spurs action a lot more than positivity does. For instance, it doesn't make as strong of a case for that advisor if your probability of success goes from an 88% to a 92%. But we see negativity as a growing trend in the media as well. Over the last 20 years, the frequency of negatively skewed articles has increased year by year. This is why I recommend a lot of retirees avoid the news. It's arguably the biggest peace of mind improving step that you can take, because turn on the news and all you hear these days is that America is in a retirement crisis and the economy is on a razor's edge and more. Now, we can sit and blame the media, but it's worth noting that they're just following incentives. Across the board, it's been shown that negativity leads to higher click-through rates, which ultimately leads to an action from the consumer. So we can see why this advisor tactic can be so effective, and it goes even beyond advisors. So from here, I want to discuss some reasons probability success scores are problematic in general, and then give you some tips on how to identify if you're being deceived by an advisor. On the surface, probability success scores seem great because they give you an immediate summary of the results. These scores are binary. You either passed or you failed. You were either successful or not. It's very easy for the human brain to understand. And this is why the human brain loves binary outcomes. They are completely devoid of context, however. For instance, if you have 64% probability of success, but your plan is run out to age 100 and all the failures come in the last 5 years, that's nowhere near the same as a 64% probability of success with your plan being run to age 85. On top of this, what is a good probability of success score in the first place? Should you be trying to get a score in the 90s? Could a 65% score be satisfactory? It really depends on the context and assumptions being used. Typically, probability of success scores will treat every goal the same. So maybe you want to live on $8,000 per month in retirement. But if things go well, you might want to give some money to charity, go on a few bigger vacations here and there, and then maybe even leave some money to the next generation. Well, often probability success scores will treat giving to charity as the same importance as your $8,000 per month spending goal. So you might have a 95% success score of hitting that spending goal, but only a 6% chance of being able to give to charity. And because of this, the success score of reaching all of your goals is 60%. In reality, though, you're only going to give to charity if things are going well, and therefore will make adjustments as you go, which this success score will not factor in. Again, this is where context around this score is ultra important. You should never just accept a score without digging deeper into what that score actually means for you. For instance, some softwares will allow you to look at specific trials to identify when and why failures are happening. Say we are running 1,000 trials and find that failures happen 25% of the time. Well, we can look at trial 770, a failing trial, and we might see the expected return for your portfolio is normally 7%, but this specific situation is failing because the return of this trial is only 3.3%. Before, the failure in trial 770 was viewed negatively. But after digging into the context, you might actually be willing to accept this failure. Why is this failure less drastic when viewed in this context? Well, historically speaking, a 3.3% return on a balanced portfolio over an entire retirement would be worse than any historical period that we've seen since 1950. In fact, the worst 20-year return for this type of portfolio was just below 5.5%. Viewed in this way, we might be completely willing to accept failures under a certain level. Every retiree needs to decide what level of failure they are ultimately comfortable with. No matter how much money that you have, I could create a hypothetical scenario where every plan ultimately fails. You can also use historical returns as a guide to determine if that advisor is being deceptive in their assumptions. Say that you're using 5% stock returns as the base assumption in running your analysis. This is quite below historical averages or even median returns and should raise red flags as to why they are choosing that low of a future assumption. And so if you're in the situation where an advisor gives you an initially poor success score that is improved through utilizing their strategies, again, it doesn't mean that advisor is automatically being deceptive. But here's the first question I would ask in order to try to determine if they are. What things are causing the biggest improvements in that success score? What are the strategies you are recommending that would make this big of an improvement? We're trying to go here from generalities like a binary success score and dig into specifics. For instance, let's say their answer is that the main improvement would be implementing a much better tax strategy of Roth conversions and strategic withdrawals. Although this is a completely legitimate improver to a plan, I've never seen a plan where a tax strategy adds 30 percentage points to a success score. Tax saving strategies are typically most effective for those at higher net worth levels. Some of these people often have levels of safety in the income that they want to take relative to their asset. For someone whose plan is right on the edge of being successful, tax benefits are important, but are going to lead to marginal improvements. Maybe they can lift you from a 64% score to a 70% score. Okay, I can buy that. But a massive shift in scores typically means there's more going on here than just the tax strategy. Say that advisor says that these improvements are coming from using a guaranteed income strategy or some kind of active management strategy. Let's tackle a guaranteed income strategy like buying income annuities first. For there to be a large phase shift in the score due to this strategy, the return assumptions that advisor is using have to be quite low. Remember, in a normal market environment, there's an inherent expectation that annuities will offer a lower return than risk-based assets. If this weren't the case, then income annuities would be a free lunch and we would all be using them. Income annuities are used mainly for peace of mind and longevity risk reasons. So you should be very skeptical if you're seeing this big of an improvement from using a quote-unquote safer investment product. Let's say instead this advisor is not recommending income annuities, but instead recommending your stock strategy should be investing in individual stocks or an actively managed portfolio or some other type of strategy that is leading to all of this improvement. Let's say right now you're investing in index funds. Your probability of success right now isn't improving because of the strategy, but rather the assumptions the advisor is using around their strategy. If behind the scenes they're assuming index funds average 8% per year, but their active strategy averages 11% per year, you better have a lot of confidence that they can deliver on the difference in returns, or the whole analysis is built on a house of cards. But to be clear, there are legitimate ways you could see an improvement this big. Say you are overallocated to cash and safety, and that advisor is recommending a more balanced portfolio. This is 100% a valid reason for that success score going up that much. Adding a few percentage points of return while maintaining adequate safety will no doubt compound into higher chances of success. Or maybe there are multiple areas of improvement, like some benefits from a tax strategy, some benefits from a better Social Security strategy, some benefits from a better investment strategy. If the improvement in the success score is distributed amongst a number of improvements, okay, that is more likely to be legitimate as well. And so here are some things you can do to avoid being caught in this deception. Number one, ask questions. Even if you aren't savvy in the world of finance, asking simple questions like the one we just covered can often give you more information and context around a score. If that advisor has confident answers that make logical sense, this should give you more confidence versus someone who visibly squirms in their seat as you dig deeper. Number two, get a second opinion. If that second opinion gives you a widely different analysis, then this can give us a clue that someone might be full of, well, you get it. Then number three, ask them to explain the context around the current probability of success. Break out the success score of each of your core goals to see if the bad results are simply coming from using binary methods like probability success scores. Now, hopefully you found this video helpful. I would love to hear from you if you've had any negative experiences with a financial advisor where they use a less than honest tactic to try to gain your business. If you like this video, I have another video that you might also find interesting. Click here to learn about 7 common realizations retirees have in the first few years of retirement. Click here to learn more, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.